wanted to spend a minute or two here on the Senior Loan Officer Survey. So this is the quarterly report the Fed puts out. I do tend to touch on it most quarters, but this quarter is particularly notable and interesting. So without being hyperbolic, the reversal here is extraordinary. So credit conditions tightened across the board to a degree that haven't seen in a very long time. We found that of the three questions that are asked, those three questions being to loan officers, are you tightening standards, meaning underwriting standards? Are you increasing spreads? And are you seeing stronger demand? When two of those three have inflected to net tightening conditions, you've had a recession every time shortly thereafter. So, in all cases, we're seeing this here. So, massive increase in the net percentage of firms tightening standards on C&I lending, very large increase in those increasing spreads. What is interesting is that demand actually got stronger, and historically, you would see, at least based on prior cycles, you would see demand fall off. I wonder if part of this, the rise in demand is that firms are basically trying to draw down lines, and establish lines here sort of late in the cycle to contend with these different pressures they're facing. On the CRE side, it's actually even worse. The thing I would remind people is technically, this is a backward-looking survey because the survey period was the last 2 weeks of June, which was a month ago. But this is really a forward-looking survey because this is like the definition of reflexive, right? Like when banks in the aggregate are tightening financial conditions, that creates this growth slowdown, this growth drag that then precipitates credit problems, which then causes banks to further tighten. And so if you go back and you look at every historical cycle, you don't see a reversal in this this financial condition setup until very far into the point where the Fed has been easing. The Fed has been cutting rates. So like if you go back and overlay Fed funds against these condition sets, you find that normally you see this reversal, meaning a tilt toward easing on the margin only after the Fed has already eased a lot. So this is sort of where the rubber meets the road with respect to this whole sort of pivot bull case, is that how far out over your ski tips are you getting, you being the market, in expecting this to sort of be there and when it's all going to manifest.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.